With interest rate increases all over the headlines, we've been getting a lot of questions from our clients about whether they should be going fixed versus variable and what they should be doing for financing. And we always refer them straight to Chris and Dave here at 4Front Mortgages. So we thought we'd do a little video, answer some of the most basic questions we've been getting over the last little while. So I'd love to introduce you to Chris Cornborough and Dave Goodison here at 4Front Mortgages. So let's talk interest rate increases. The Bank of Canada has already increased rates twice this year. What impact has that had on borrowers with fixed rate mortgages versus variable rate mortgages?
For sure. And I guess the key thing to note here is when we're talking about the Bank of Canada raising interest rates, there's a lot of anxiety when they do talk about it, and they're going to meet June 1st, likely going to increase it again. The key thing to remember is that when the variable rate goes up, when the Bank of Canada increases it, there's an immediate impact to the variable rate. But in most cases with fixed rates, they anticipate what's going to happen with interest rates. So we've already seen fixed rates. In the fall, we were about 2%, and now we're over 4% on fixed rates. So what we've seen is that the fixed rates have anticipated that the variable rate's going to go up, and they've already gone up.
Wow. And what's the difference between variable rates in the fall versus now?
Variable rates were about 0.75% or 75 bips lower in the fall. So we've seen an increase so far of 0.75%, but with fixed rates, they've gone up well over 2%. So again, you can see that they don't go in lockstep at the same pace, but they do go in the same direction.
So say for an average homeowner with, say, a $500,000 mortgage, what impact does that have on their monthly payments?
Sure. No, it's a great question. For every quarter point raise in the interest rates, it's about $65 for a $500,000 mortgage.
Okay.
So, you know, a quarter point raise doesn't really impact people's budgets that much, but we've seen a quarter point followed by a half point, followed by another half point. So, you know, as those layer on top of each other, we are going to see increases on people's monthly payments.
So let's talk about the stress test and qualifying. That's been a hot topic with you guys, and it seems like it might be getting harder for buyers to qualify.
It might be, yeah.
It might be.
So the way the stress test is calculated, it's set by the federal government. It's 525 or your rate plus 2%.
Oh, okay.
So as rates go up, potentially that stress test could get higher, so you qualify for less, which is interesting. So this is the first time we've actually run into this for, I think, 4 or 5 years. As rates have come down, the stress test has always been at basically 5.25 forever.
Right.
And in fact, I think they lowered it from 5.45 maybe in like 2019.
Yeah.
So it's never really been much of an issue. Everyone has to qualify for the stress test, generally speaking, whether you're CMHC insured or you've got 20% down. Credit unions have a slightly different stress test, but for our intent and purposes, it's always been 5.25.
Okay.
But now with fixed rates at say 4.5 plus 2%, now you have to qualify at 6.5% versus 5.25.
Wow.
So it can be impactful for those borrowers, especially if you're right at the top of your affordability range.
Wow.
It could potentially make you go variable because the variable rates are still below that 5.25. When you take your variable rate and add 2%, you're still below 5.25. So the stress test doesn't impact variable borrowers as much as it does with a fixed rate borrower.
This might be a silly question, but could you qualify at a variable rate and then still go with a fixed rate, or that's not an option?
It's a sneaky maneuver, but you could get approved as a variable rate and then the next day lock in to a fixed rate and you wouldn't have to requalify.
Okay.
And that brings up another point too. If you're renewing your mortgage, you generally don't have to requalify if you stay with the same lender.
Okay.
So if you've got a mortgage coming up this year and this is freaking you out, it's not really going to be impactful to you as long as you don't need to modify your mortgage in any way. So
does not modifying it mean that you can't go from fixed to variable, or?
No, you just can't borrow any more money. So you could change if you're coming out of a fixed rate, for example, and you want to go variable or you want to go into another fixed rate, you don't have to requalify as long as you stay with the same lender, generally speaking.
That's really interesting.
Yeah.
So with that said, what are your recommendations for people who have their mortgages coming up for renewal? Like we said, you know, maybe this year or maybe in 2 years. Should they be looking at possibly refinancing earlier, or what?
It's hard to say. I mean, I think if you've got a mortgage coming up this year, I would encourage you to reach out to your mortgage broker, or if you're with a bank, you know, of course, reach out to us first. But if you have to go to your bank or your lender, reach out as early as possible, because in some instances you can renew early, or it could be worthwhile to break your mortgage early to get into a rate now if you're concerned about rates moving up. So there's no right or wrong answer or no right or wrong time frame.
Yeah.
But I think it's always better to have more time than less.
To start planning early.
Exactly. Yeah.
Right.
Yeah.
So one thing that we've been seeing in the market, especially in the lower end price points, is people rushing to try to get in with their existing rate holds before they expire, which a lot of them seem to be in May or June. Are you seeing that on your end? And what are your recommendations for clients who have that rate hold that's about to expire, but they haven't yet found a property?
Yeah, absolutely. We're seeing, this speaks more to kind of the consumer behavior with the interest rates, because we're seeing customers that are trying to get in right away because those rate holds do expire. How it works generally with most lenders is you'll get a rate hold for 120 days. So since the fall, the interest rates have certainly gone up. And so the rate holds, as we get further along that linear calendar line, those rate holds will start to expire of those lower rates, and people will have to get rate holds at higher rates. So we have a lot of people right now trying to close a deal in May, even though they're not ready to move until June, because they want to capture that rate hold from back then. So one thing we do for our clients to try to de-risk the situation and give them the most options, because we're brokers and we don't work for one lender, what we can do is actually ladder your pre-approvals and your rate holds. So, you know, we get you on today's date, we'll get a rate hold, and then a couple weeks later, we'll get another one. So what that does is it makes that 120 days more like 150, 180.
So
and you're
more
always,
time to find
exactly.
the right place.
It hopefully takes some of the pressure off. Yeah.
With more interest rate increases expected for this year, what are your recommendations to buyers looking to get into the market and how they could mitigate that risk?
Yeah, I'd say this is for any big decision that you have, is really you need to spend the time to figure out what your priorities are and what's important to you. So just like you talk with a DNA to figure out what's the right home, what's the right property for you, when you work with a mortgage professional, you should be spending the time up front in the process to figure out what your options are. You know, fixed versus variable. Do you want to work with a credit union or a bank? You know, is the solution, like the type of mortgage, important to you? Timelines. So there's a lot of factors that go into it, not just rate. Rate's a huge driver, but there's a lot of other considerations that people have.
So we often hear from mortgage brokers, you know, that rate isn't everything, but why is that? Like, what are some specific examples or pitfalls you've seen buyers fall into that were too focused on their rate?
I think right now a lot of people they hear rates are going up, they're locking into a fixed rate, so they want to talk about a fixed rate. But the fixed rate can be large prepayment penalties.
Right. How large?
It could be pretty significant.
Right.
It could be, say, 3% of the mortgage amount,
Wow.
for example. We had clients recently who they were a division of assets, and because they were breaking their fixed rate mortgage, the penalty was pretty significant. We're talking like $50,000.
Wow.
Where an equivalent penalty on a variable rate would be $8,000, for example. So there are some biggest downsides to having a fixed rate.
Right.
Are you going to move? Are you going to be in the home for the full term, for the 5 years?
Right.
Right. Or do you want to pay the mortgage off sooner? You know, will you want to, you know, maybe refinance that home, for example, or switch different lenders? There are things other than the rate that are certainly important to consider.
What about the term? Like, are you recommending people lock in for longer terms now or shorter terms? Like, what do you think?
I would say, if anything, probably shorter terms.
Okay.
The way that I feel the interest rate kind of cycle will play out is we'll have rates high for about a year and a half. And I think what's going to have to happen is they're going to have to bring rates back down at some point. They are very high. If you kind of came in today fresh, I probably wouldn't recommend a fixed rate. I actually would go variable, but make the payment as if you had taken the fixed rate. So pay a little bit more off the mortgage. That's right on principal.
Yep.
And then you've got a little bit more flexibility. I feel like you could get a better fixed rate in a couple years. So if you go variable, keep in mind you can always switch to a fixed rate with no cost.
But you can't switch from fixed to a variable.
Once you're fixed, you're fixed. Without a penalty.
Right.
Yeah.
So Dave, do you have any examples of why it might benefit for someone to go with a credit union versus a bank in certain situations?
Yeah, absolutely. I'd say there's probably two main situations where credit unions have really helped out our clients in the past. One is they don't have to use that stress test. They have their own version of it, but because they're provincially regulated, they can use their own version. The main difference is one of our customers came to us and they were able to have 20% more in their buying power. So they were getting a mortgage of about $500,000 with the bank, and we were able to get them about $650,000, I think. So it was a pretty noticeable difference from a mortgage perspective.
Wow.
The second thing that we're seeing a lot with credit unions is, and this will sound a little cliche, but the banks are saying no either because of credit or their job type, so self-employed, and credit unions are much more understanding.
Oh, that's good. So you'd have more options and potentially more borrowing power in some situations.
Absolutely, yeah.
What are some other pitfalls that you've seen buyers fall into in the last little while as they've been trying to get financing that's gotten in the way?
We've had some pretty interesting clients in the last little while here. I would say make sure you keep your job until you get your keys to your house.
Okay.
Don't buy a new car or truck or a snowmobile, for example.
And I think a lot of people don't know that because it's not not after subject removal. You're talking about between subject removal and completion.
Absolutely, yeah.
If you do one of these things.
If you move employers or you take on some debt, potentially you can jeopardize your application, and the bank will re-underwrite it, and you might not qualify.
Oh, wow.
Yeah. Bitcoin, unfortunately, like, I love Bitcoin myself. I'm all in, but don't tell us you have Bitcoin, and don't tell the bank you have Bitcoin, because it's still a no-go zone for whatever reason.
Interesting.
Yeah.
So we've noticed in the last few weeks you guys are requesting a lot more documents from our clients for their financing. What are you seeing? Are banks tightening up? What are you seeing on your end?
I think they are. I think this happens and it's an ebb and flow situation, but the banks are asking for, certainly we want to get appraisals done on most properties nowadays. They're looking through the strata minutes and they want to see your bank account history and your employment to confirm you're still working. This is kind of a COVID issue where they really wanted to make sure you weren't laid off or temporarily unemployed. So they're asking for 90 days of bank statements. They're calling employers to make sure you're still working there, which is normal. I mean, you'd expect them to do this anyway, but I think they still have that kind of mindset of things could change and they want to make sure that they're giving loans to the right people under the right circumstances.
What happens if someone's laid off between subject removal and closing?
Usually we'd like to get the income documents into the bank up front, so that condition is satisfied. So generally speaking, it can be avoided or we can get around it to a degree. Obviously it's unfortunate, and I would imagine it would be stressful as a buyer if you've removed subjects and then you lose your job. But also I think on the flip side, if you have a new job, the lenders aren't requiring you to be there forever. You know, if you have a paycheck, they're good with it.
They're good.
Yeah.
Thanks so much for your time. I hope you found this valuable. If you have any more questions, you can reach out directly to Chris or Dave here at 4Front Mortgages.
Thank you, Dina.
My pleasure. Thank you.